Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Agnico Eagle Mine stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Agnico is a producer of gold with operations in Australia, Canada, Finland, and Mexico. In the fourth quarter of 2021, it acquired Kirkland Lake Gold. Last month in February, Kirkland stock was removed from the TSX and New York Stock Exchange. If you own 5 shares of Kirkland, you will receive 4 shares of Agnico post-merger. It's roughly 1 share of Kirkland equals 0.79 shares of Agnico. Agnico is headquartered in Toronto, Ontario, Canada, and was founded in 1953. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Swiss, Buenos Aires, and TSX. Let's get started with the model. This is a large cap company, 28 billion market cap. They're trading at $61 a share, and they have 455 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow improves each year from negative 500 million to 448 million. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that also improves each year from negative 300 million to 540 million. Revenue is sales for the company, and that looks great from 2.2 billion to 3.8 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. All the expenses to pull the gold is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that goes from $500 million to 1.3 billion. Below that is their operating expenses. Examples of operating expenses are depreciation, but you may also see depreciation in cost of revenue as well. Below that is their operating income, and that goes from 200 million to 1 billion. They spent 92 million of interest on their debt, which is a little higher than 2018 of 86 million. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example of something in this category is an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which looks really good. It went from negative 300 million to 540 million. This is the company's income statement directly from their financial reporting. This shows us 2020, 2021, the fourth quarter of 2020, and the fourth quarter of 2021. You have your revenue on top. That was 3.8 billion in 2021. Production cost is 1.8 billion. Here's a breakdown of their revenue and production costs by mine. Their northern business has 8 mines and their southern business has 3 mines. Not all locations are equal. It may be expensive to pull gold from certain locations, so the margins will be lower. To give you an example, say there was a mine and it took 1 hour to get to that mine, and there was another mine it took you 12 hours to get to. So it's going to cost a lot more money to bring people to the mine that's 12 hours away than the mine that's 1 hour away. Regardless of how you get there, whether by truck or plane, the fuel expenses will be higher. And if you have to bring equipment to the location, it's going to cost a lot of money to get that equipment there. That's just one example. Say you have 2 locations and both of them are 1 hour away. But one location, it could be really difficult to extract gold from, while another location, it could be a lot easier. So your expenses are going to be higher at the location it's more challenging to pull gold from. You could figure all this out by looking at the company's operating margins. So take the operating profit and divide by the revenue. The higher the percentage, the more profitable that location is. They spent 152 million in exploration and corporate development. Before they start to physically extract the gold from a location, they have to first identify if it even has gold. 700 million in amortization, 142 million in general and administrative, 92 million of interest on their debt, and a bunch of other smaller items. Their operating income is up from 770 million to 900 million. But their revenue is also up from 2020, so their margins are probably pretty similar. And their net income is up slightly from 511 million to 543 million. This is how you identify if they're more profitable, the income per share. It is up 11 cents from 212 to 223. If you own one share in 2020, your portion of the net income was $2.12. In 2021, it was $2.23. If all the shares were diluted, it would be $2.22. An example of diluted shares is if someone owns convertible debt, and if they converted that debt to equity, that would increase the shares outstanding, making everybody's earnings per share lower. But the fourth quarter of 2021 was a lot worse than the fourth quarter of 2020. It was less than half as profitable. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Their operating cash flow more than doubled from $600 million to $1.3 billion. They also have to invest a lot in CapEx. These are investments in property, plant, and equipment. When they purchase the rights to a location, that's part of CapEx. And when they buy equipment to extract the gold and process it, that's also part of CapEx. Operating cash flow minus CapEx gives you your free cash flow. And if free cash flow was negative in 2018 and 2019, now it's positive, over $400 million in 2020 and 2021. They do pay a dividend with their free cash flow. It also looks like they're paying down debt. In 2019, 2020, and 2021, they paid down more debt than they issued. In 2018, they added about $350 million of debt. This is their operating cash flows directly from their financial reporting. And this gives us 2020, 2021, the fourth quarter of 2020, and the fourth quarter of 2021. In 2021, even though they reported net income of $540 million, they actually generated $1.3 billion of cash flow. A bulk of that is from amortization of over $700 million. Amortization is a non-cash item that brings down your net income, but we add it back here. They generated a lot more cash flow in the fourth quarter of 2020 compared to the fourth quarter of 2021. I like to track revenue, that's the blue line, and operating cash flow, that's the orange line. And you can see their revenue looks really good. Revenue growth for this company can stem from three things. They can be selling more gold, or maybe the price of gold is increasing, or maybe they're acquiring companies. But as an investor, I prefer to see revenue increasing and operating cash flow increasing, and both of that is happening with this company. The forecast is for their revenue to grow a lot in 2022, then remain pretty steady in 2023 and 2024, and then it's expected to decline a little in 2024. The same pattern with their operating cash flow. This is their investing and financing sections from their statement of cash flows. In their investing section on the top, that's investments in property, plant, and equipment. In 2021, they invested $870 million. In 2020, $759 million. In the fourth quarter of 2021, $237 million. In the fourth quarter of 2020, $224 million. In 2021, they acquired TMAC Resources. They paid $186 million of cash, and they gave them $105 million to pay down their debt. They also acquired Hope Bay Royalty for $50 million. So that's probably why their revenue went up a lot, due to these acquisitions. They purchased $40 million of equity securities. These are investments in other companies, probably gold companies. In their investing section, they had a cash outflow of $1.2 billion. Last year was a cash outflow of $800 million. It looks like they didn't do any acquisitions last year. In their financing section, they received $600 million from a credit facility, and it looks like sometime later in 2021, they paid down that facility. They paid out $275 million of dividends. Last year was $190 million. They bought back $35 million of common stock. Last year, they bought back $40 million. In their financing section in 2020 and 2021, they had a cash outflow of $300 million. This is the equity section on their 12/31 balance sheet. They have $6 billion of equity. They raised about $6 billion from selling common stock, and they lost $165 billion from running their business. If this number was positive, it would say retained earnings, but since it's negative, it says deficit, or it may say accumulated deficit. This is the sum of all their prior net incomes minus the sum of the dividends they paid out. Now that they have positive net income, this number should be positive sometime this year or maybe next year. Let's look at the capital structure. They have $6 billion of equity, $1.7 billion of debt. They're 78% equity, 22% debt. Since 2015, their equity balance has been increasing. Their debt balance is pretty steady. It did go up in 2020, but it came back down. And this green line is their cash balance. The reason their debt and cash spiked at the same time is because they took out debt and received the cash. Then shortly after taking on that debt, they paid it down. That's why their cash and debt went down. I gave them the lowest whack on Finbox, 6.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $17 billion. We divide that by 455 million shares. And we get a calculated stock price of $38. They're trading at $61, so they're trading at a 61% premium. It's a sell according to the model. Their revenue is projected to grow 12%, so I grew their revenue 12% for the next 4 years. That's how I got their future revenue estimates. Their industry is only expected to grow 1.1%. The reason their revenue growth is so much more than their industry is because of all the acquisitions they're doing, mainly the Kirkland acquisition. In 2020 and 2021, they converted 13% of their revenue into free cash flow. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. The website Simply Wall Street is in the other direction. They're at $90 a share. They're saying it's 32% undervalued. 12 analysts priced this stock and the average price target is $68. The low is $52, the high is $88. This is where the stock has been trading the last 5 years. It was below 50 in 2017-18 and the beginning of 2019. Then it shot up to over $80 in the middle of 2021. And it fell below $50 recently, but it's come back up from the bottom, sitting at around $61. You can see this company's stock price move with the price of gold up through the beginning of 2021. And this stock has done much worse than gold. And gold is pretty much steady in 2021. It's actually up a little bit. But this company's stock has come down a lot. Maybe due to all the acquisitions, the stock price has come down. This is the largest gold miner, Newmont. And you can see their stock price tracks gold much closer. They're trading at an all-time high right now. And gold is pretty much trading at an all-time high the past 5 years. In the past 5 years, the S&P is up 77%, while this stock is only up 49%. And this stock was tracking the S&P for a while. Then it started beating the S&P by quite a bit. But ever since mid-2021, the stock has really struggled. This year, the company is projecting to produce 3.3 million ounces of gold. 85% of that is in Canada. It currently has 45 million ounces of gold reserves. 74% of that is in Canada. Here's a list of the locations that are projected to produce the most gold this year. Detour Lake, 715,000 ounces. That's in Canada. The second largest one's in Australia. The next 4 are in Canada, then Finland, then 2 in Canada, then 2 in Mexico. They do have less gold reserves than Newmont, Newcrest, and Barrick, but more than Kinross. In 2021, they more than doubled their gold reserves, while these other 4 companies decreased their gold reserves. Their beta is below 1, so the stock is less volatile than the market. It's gone up 3% in the past 52 weeks, while the S&P is up 6%. The 52-week low is 45, the high is 75. And the stock is trading above its 50-day and 200-day moving average. This stock has gotten a lot of activity the past 10 trading days. Over 6 million shares have been traded each day. Pretty much all the shares outstanding are on float. 40% are held by institutions and less than 1% of the shares are shorted. They've paid a dividend since 1983 and they raise their dividend every year. They're up to 40 cents a share, which is 2.6%. But they may need to cut their dividend because it's more than their net income and free cash flow. This is their dividend yield since 2011, and it seems to be all over the place. It was below 1% for a few years. Now it's at a high point, about 3%. The forecast is for the yield to decrease to 2.5%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $20,000 today. That's a 7% annual return. Their employee count has gone up slightly the past few years. They employ over 6,000 people. There's been more insider buying than selling the past year. 3 insiders have bought the stock and 2 have sold. 58% of the company is held by the general public and 42% by institutions. Individual insiders don't own that much of the company. BlackRock is the biggest shareholder at 4%, then Van Eck, Massachusetts Financial Services, Vanguard, and RBC. Let's look at their financial ratios. They have a pretty high PE of 51. That's stock price over earnings per share. Price of sales of 7.3, that's stock price over sales per share. The market average is 9.3, and price to book of 4.7, that's stock price over book value per share. Let's look at their non-current assets. $400 million of goodwill. Goodwill is the premium you pay when you acquire another company. $7.6 billion of property, plant, and equipment. $340 million of investments, and $350 million of other. Let's look at their non-current liabilities. $1.3 billion of debt. They owe $98 million of lease payments, $722 million of reclamation provision. This is not a common term I've seen before, but a provision is when you post funds for future losses. It looks like that money is being reclaimed. Since it's in the liability section, they're the ones who have to pay the provision. If it was an asset, they would be the ones receiving it. $1.2 billion of mining tax liabilities. This will increase their taxes in the future. And $70 million of other. They have a good return on invested capital of 11%. They can cover their interest payments 11 times with their operating income. Their ROE is 9%. The market median is 7%. The average is 2%. They have a good current ratio of 1.7. That's current assets over current liabilities. But their quick ratio is 0.6. Quick ratio is when you take current assets and you minus inventory. And you take that number and divide by current liabilities. Let's look at their current assets. $185 million of cash, $5 million of short-term investments, $13.5 million of trade receivables. This is how much money is owed to them. $880 million of inventory. This is their gold. $8 million of income taxes they need to recover. $12 million of derivatives and $200 million of other. Let's look at their current liabilities. $415 million of accounts payable. This is how much money they owe others. $8 million on a reclamation provision. $12 million of interest payable. This is interest they owe on their debt. $47 million of income taxes payable. This is the taxes they owe the government. $33 million they owe on their leases. $225 million of debt. And $22 million of derivatives. They generated $448 million of free cash flow in 2021. They have $540 million of working capital, and they pay out $728 million of dividend payments. So it looks like they may have enough money to get through the next 12 months without needing to add more debt. The best way to look at ratios is to compare them to companies in the same industry. There are 44 companies in the same industry as Agnico, and they rank 4th in market cap at $28 billion. The average is $6.5 billion. Newmont is the largest by far. They do pay a higher dividend than the average company, but you can see their price multiples are worse than average, which would indicate the stock is overvalued. But they're growing a lot more than average. Their revenue growth is fairly similar to the top 3 companies. To summarize, I have them trading at a 61% premium. When you invest in a gold mining stock, the price of gold has the most influence on the stock price. If the price of gold went up 50% or doubled, then everybody who owns gold stocks will make more money. And if the price of gold goes down 50%, then everybody who owns gold stocks will lose money. So the only thing you can do is try to identify the stocks that may be more undervalued than others. Another thing to look at are the companies with good management that are trying to grow their business organically and make smart acquisitions. So there's a lot of things to look at, but the main thing is the price of gold. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.